Hello, and thank you for joining us on the Optimal Wealth Podcast, where we discuss creating passive income through real estate. Our mission is to help educate investors on how to grow wealth and invest passively. My name is Jarod Alexander, and I am a passive investor, currently in 6 syndications as a limited partner. I am also the founder of Optimal Equity Group, which is a real estate investment firm that was created primarily to help educate the passive investor. We do that in a couple of different ways. One is we provide education to help give you the confidence to get into the passive investing space. And two, each episode we will interview amazing guests that explore the strategies, insights, and secrets used by successful investors. Whether you're a seasoned investor or just starting out on your real estate journey, this podcast is designed to help give you the confidence and knowledge you need to make informed and profitable decisions. Welcome to another episode of the Optimal Wealth Podcast. My name is Jarod Alexander, and I'm your host. And today I'm super excited to have with us Erick Hemingway. Erick, welcome to the show.
Thank you, sir. Appreciate you having me on.
Yeah, of course. Well, it's interesting. We were just chatting a little bit before we got started here, and I met Erick through Jason Dree's community through the JDC, a mindset coaching program, and I was, just connecting with others, and I happened to call him when I was up in Prescott, Arizona, and I'm driving by, and we get kind of talking, and he's from Wilmington, North Carolina, or that's where he's currently living now, and which originally I'm from Fayetteville. So, anyways, we're relating to some certain things. We get to talking about what he does, and he's in a self-storage space. And it just happens to be, I'm driving by his storage unit as we're on the phone talking for the first time, 2,500 miles across the, United States. And it's just such a small world, when you get into this space. So kind of a cool story of how we first met there. So,
yeah, that was crazy. Yeah, that was pretty surreal.
Yeah, absolutely. Well, and of course we related to so many things, on the mindset and being in the real estate world here. And I brought Erick on today because he definitely has a lot of experience in real estate, but primarily focuses on the self-storage space. So I wanted to bring him in to help educate us on the benefits and what to look for, the outlook in the next few years of what that space looks like. And just a real quick background on Erick: he has 22 years of experience in all aspects of the construction and self-storage industry, has been a part of over $100 million of commercial real estate transactions and $60 million in residential real estate since 2006. So needless to say, has some experience there. Built his first storage facility from the ground up in 2006, got it that facility through the Great Recession, and has since built a personal portfolio of 6 storage facilities using the value add strategy. And then he went on to start Nomad Capital to help others achieve the dream of nomadic freedom. I love that. And having the ability to do whatever they want, whenever they want. So, Erick, yeah, impressive background there. And if you could just walk us through a little bit more of that into some detail, and then how you transitioned into where you're at today.
Sure, absolutely. Yeah, thank you. So got married right out of high school. My wife and I got married young, so grew up in Phoenix, and then we got married in Phoenix. We wanted to start our family, moved up to Prescott, Arizona, and got into construction there just out of necessity, a job, and started at the bottom, digging ditches and cleaning out job sites, kind of getting my feet wet, really just kind of studying how to put together. I had no background in construction at all. And eventually started becoming a superintendent, project manager for 7 years, worked for a great guy in Prescott, and then went on my own, got my license in 2001. And started my construction company called Elm Builders, and Elm like the tree. And that was named after, we had 3 kids at the time, Levi and Maggie. So that's where we came up with Elm. And just started building spec homes, customs. And then in 2006, had an opportunity to build a self-storage facility. No idea what I was doing, but back in those days, the good old days, as we say now, it was much easier to get financing. talked to a bank that I had a relationship with, and he said, absolutely, yeah, we can finance a storage, and built one in just outside of Prescott, Arizona, the one you drove by, and we still own it today. Just did a 30,000 foot expansion there last year. So yeah, so that was my kind of first dabbling into commercial real estate and self storage. Fast forward a little bit to 2007, we had the opportunity to move abroad to Costa Rica. There was a job opportunity there. A friend that I had met in Prescott was bought a big piece of property and was selling lots, and invited me to come down and build houses for Americans and Canadians building second homes. So we moved our family. We had 5 kids at the time. We moved our family down to Costa Rica, lived there for a year and a half, and yeah, built 3 projects. And then when the 2008 recession happened, everything kind of slowed down because Canadians weren't weren't in the mood for second homes anymore. So that kind of slowed down. But then we pivoted. Me being in construction, there wasn't a lot of us at that point. So my wife and I had talked about traveling abroad with our kids for probably 7 or 8 years. That was part of the motivation to this, just live more intentionally of where we were going and what we were doing. So when things slowed down in Rica, we ended up buying a sailboat in Greece and moved our family over there, thinking that we were going to be on the boat for 1 year, sail around a few Greek islands and sell the boat. But that kind of mushroomed into a bigger adventure. We ended up being on the boat for 3.5 years, visited 25 countries, had a baby in Israel, sailed across the Mediterranean and the Atlantic, and then sailed up through the Caribbean. And that's how we got to Wilmington, North Carolina. So we talk a lot about like living like a nomad, and that's really what we did. We were just kind of open-ended trip, not really sure, how or when it was going to end. But the reason we were able to do that is through passive income from commercial real estate. So that's what we're really passionate about, is how to help others achieve that kind of, not that they have to go sail halfway around the world, but everybody has huge goals, I think, or dreams that they want to accomplish. And I can't think of any better way than commercial real estate or real estate in general to kind of achieve those goals. That's just seems like a fantastic opportunity for people that want to get after it, that they can kind of build that lifestyle for themselves. So that's why we started Nomad Capital. And when I say we, it's my son and I are partners. He's 29 this year. Yeah, so we're very passionate about helping investors, whatever nomadic lifestyle looks like for them, working remotely, taking off big chunks of time with their families, living kind of life on their terms, how they want, where they want, and we're just trying to give those tools to people so they can do that.
Absolutely. Well, man, I love that. Love that. And a lot to unpack there, Eric. I was actually real quick before we get into that, if you could explain to listeners what is a nomad? What is the definition of a nomad there?
The way we talk about it is people, are ultimately, they're not really seeking money necessarily. They're seeking what money gives them, right?
Yep.
And money gives you. So is it freedom of time, freedom of location, freedom from, kind of the daily grind? And I think all of those three are combined, and that leads to a freedom of purpose. And that's what a nomad means to us. Like I said, it doesn't mean you have to travel around the world, but you can live life on your terms is how we define it. So that's why we started Nomad Capital. So that's kind of what we're after.
Yeah, thanks for explaining that. I remember when we first talked, you were kind of going through that, and then I love that, the meaning, especially the way y'all define that. Is I think that's why a lot of us are doing what we do, right? Is to have more time, freedom to spend with our loved ones. I love the fact that I was actually reading through on your website, and I saw bought a 37-foot catamaran, right, in Greece.
Yep. Yes, sir.
Planning to travel for a year, which is awesome. And then I just want to highlight again, like you said, Eric, that this was as a result of the sale of commercial properties and the passive cash flow from the self-storage facility that allowed his family to do this traveling, right?
Yep.
Like
Yep.
that is the power of what we're doing and what we're talking about here today. And of
Right.
course, Eric didn't get, this overnight, right? It took a lot of work and years of doing this, but as a result, like these are the rewards we get from passive investing, building cash flow. And also, I mean, I love how you utilize your construction background to go out and start building these properties and become an active real estate investor, right? And participate in these deals. Cause a lot of contractors, they just stick to contracting, right?
Yeah.
Developing, and they have their business and they can do very well. But you kind of paired that with okay, and I definitely know you brought that into the self-storage space of okay, I got the contracting business, so you have all those resources, right? Which is huge, of course, in new development. Paired that with now we're going to build self-storage, and I'm curious, did you syndicate that first deal in 2006, or did you just you get money from the bank and do all that yourself?
Yeah. We did it ourselves. We weren't smart enough to syndicate, and we didn't really know what it was, first of all.
Right.
Had never heard about it. And I'm very much a figure it out kind of guy. So, get the bank loan, and then how are we going to get down payment? We ended up using a home equity line of credit and, kind of whatever resources we had saved up, our cash. And, it's a lot of risk, obviously, right? But we didn't partner with other people. We just went it ourselves, and the project made sense to me to do it ourselves. And so that's what we did. Turned out to be fantastic. So when we got back to North Carolina, we continued to get back into the self storage business. We did two properties in Wilmington here, one in Greensboro, and we really wanted to build that backbone of cash flowing property before we started syndicating, just because we had seen by then we started unpacking syndications and just didn't want to get into that trap that we saw other groups get into. Where you're kind of just chasing marginal deals or feeling the pressure to do deals that maybe aren't great for the investor or the syndicator. Good for investors, but just kind of going deal to deal just for acquisitions fees, or kind of doing the volume game. And we didn't want to do that. So we really focused on, let's build a portfolio of cash flowing assets that we don't have investors on, and then we can springboard into syndicating. So yeah, so we're up to 12 facilities now, and really focusing on conversions is our big on self-storage conversions. So we like to convert whatever we can find. Either it's an old mill, we're working on that. We're doing a soda bottling facility that we bought that we're converting climate controlled self-storage. We've done two Kmarts, a grocery store, printing factory, kind of any building that we can convert to storage is what we're after. And the reason we like that strategy is because it's really a good marriage between self-storage, which we love as an asset class, and our construction team. So the construction part of our business is really our secret weapon. I mean, that's how we're able to create a lot of value on
Yeah.
these properties, and we just create massive equity for investors and for us, and in a pretty short amount of time, much quicker than doing a ground up development. We think it's cheaper because we're buying these buildings for what, pennies on the dollar. They're just old buildings that nobody wants, but they're typically located in great locations. Kmart went to this certain corner or this location for a reason, and so that the same logic that they part there is also what makes it a great location for self storage. Great visibility, centrally located, a lot of residential. So that's kind of what we're focusing on right now throughout the Southeast. North Carolina, South Carolina, Georgia, Virginia, and Tennessee are the states are really focused on right now.
Yeah, no, I love when I would assume that definitely having a construction company gives you a leg up with buying these these buildings that like Kmart or kind of abandoned buildings, so to speak, right? That you can convert because a lot of people are just looking at how can I go out and buy a storage facility, right? And convert that, maybe expand it, create some more units, which you can create some, equity and some cash flow there. But you're doing a complete conversion, right, with your construction company, which I mean, I gotta imagine for investors, that's pretty attractive. Those are pretty attractive numbers on paper. Then again, like you said, with the ground up development or buying an existing storage building and trying to improve and renovate to increase the value there, correct?
I mean, there's plenty of groups that do buy self-store, existing storage facilities, and they see opportunity, maybe rents are where they need to be. So there's an opportunity to raise rent, raise the income, or decrease expenses. Maybe the expenses are out of line. So they're hoping for some kind of delta between to add value for investors and turn the property around. But the self-storage space is competitive, and a lot of people are after self-storage assets. So it just got too competitive for us, and we just couldn't find enough margin to be good for us and our investors. So that's why we really focus on the conversion, because we're changing asset classes, right? It's an old retail building. There is no storage there existing, and we go in and put storage there. And now all of a sudden we've changed asset class from retail to self-storage, and there's a ton of value there. So I'm happy to unpack a couple of our deals to get into numbers and kind of what we do. But yeah, happy to go whichever direction you want.
Yeah, and I definitely want to go there. And real quick, I just want to highlight, I love when you talked about just keeping it simple, right? I mean, Kmart, like Starbucks, like all these, well-known franchises, they do their due diligence and their homework, in the areas and the markets they're going in, right? Because obviously they want to increase business and just finding assets, or buildings you can buy in those areas. I mean, all the work is pretty much done. Of course, you validate it, do your own numbers on everything. But all you're really doing is, okay, now we have the building, let's convert it and let's start building a business model out of it, right? And creating
Exactly.
that revenue and that income there. So yeah, I've heard that before, and I just think let's just keep it simple, right? Good market, population growth, right? Just look at all the major factors, driving that market, and let's execute a business plan. And the biggest thing, Eric, I love would my biggest takeaway so far is just you're taking action, right? There's risk involved, like when you go back to that 2006, but you took action, you utilized your experience, with the construction, and you made things happen. And to be able to again go buy a 37-foot catamaran, right, and be able to start enjoying life with our family, which I think is a lot of us, that's our goals, right? My
Yeah.
goal is the reason I'm doing this is, I want to spend more time with my family. I want to be more present. I don't want to have to wait till I'm 65 years old, and hope I have enough retirement based on the money, I saved up to be able to enjoy life. Like we can do that now. And real
Right.
estate is a great way to do that. So, but yeah, back to what you were talking about. I'd love to unpack. So we've had some multifamily operators on here. We talked about the industrial retail space a little bit. And so I definitely want to dive into self-storage. So why self-storage? Let's just start there.
Okay. So yeah, self-storage. For a long time it was kind of the ugly duckling of commercial real estate. It took a long time for it to catch on and be respected as its own asset class. I think it's done well over the 99.com bubble. It did very well during the 2008 to 2010 recession. Performed extremely well during the COVID downturn. So it's one of those things that a lot of people in the storage talking about the 4Ds of life: divorce, death, dislocate. You have to move, and I'm going to draw a blank on the other one, but it's just all the things that come up in life, and storage is something that's very useful for all those. Downsizing, that's the other one. So any of those needs that are just continually happening in our society usually call for storage at some point, and we saw it especially during COVID, whenever started moving from one location to another. All of a sudden they could work remotely, and that kind of changed the map for a lot of people, and storage was a huge winner for that. So the metrics around storage are very strong. Probably the biggest threat to storage would be oversaturation in certain markets. Just too much storage being built, and it's just going to take a long time to absorb that. So folks that kind of the last ones in a market do have higher risk, I think, just how long it's going to take to stabilize those properties. But overall, storage has performed really well over the past 30 years. It's outperformed the S&P 500. It's outperformed every other kind of commercial real estate. It's outperformed, multifamily, industrial, office for sure has really gotten hurt the last 5 years. Yeah, so that's what that was kind of some of the reasons we liked storage and got into storage and continue to stay in it. It's been tested. but I think we think it's a great asset class. It's a pretty low lift as far as maintenance and management. You don't have tenants with, plumbing issues, toilets, and some of those headaches. It's easy if you want to evict somebody. The rents are typically month to month, so you can raise rents on a dime or lower rents on a dime. You're not locked into 1 or 2 year leases. So as the market shifts, you're able to move pretty nimble, and that's very attractive for us as well. So as the markets are increasing, we can, we have to give 30 days notice to raise rents, and then all of a sudden we're into the market instead of having to wait for leases to expire. So those are some of the reasons we really like it.
Awesome. So, and yeah, it sounds like the biggest risk is just oversaturation, right, in the marketplace. Just people coming in, just the competition. Which, you drive around town, you're definitely starting to see more and more storage buildings pop up here. But I think, again, as long as you're in a good market, a growing market, I see it all the time. People are coming and going. I like the 3Ds. I mean, it's unfortunate, but this is the reality, right? Divorce, death, dislocation, and downsizing, right?
Yeah.
It's, really covers all ends of the spectrum there. And, people need a place to store their items. And so, and it's very low maintenance too. That's one thing that's very attractive to me in storage is you don't, again, like you said, you don't have to deal with tenants, you're not having to do, I mean, you're replacing locks. You gotta, it's very low maintenance as far as having somebody manage the property. You could probably have one or two employees there, maybe probably just one, just handle the day-to-day stuff, communications. And I've even seen that systematized too, right? So it's, not a lot of involvement, from an employee. Unlike a multifamily, you have to have a property manager, you have to have a whole team built in place to manage the 200 plus tenants or whatever that is, you have there. So let's look at this. Let's dive into the numbers a little bit. So if somebody has $50,000, right, and they're looking, we're not really quite sure what asset class. Maybe let's just compare multifamily to self-storage. Like run through some numbers with us of, maybe some of these conversions you're doing with like the old Kmart's or run-of-the-mill buildings that you're acquiring. What do some of the numbers look like? And again, these are numbers going to be based on some past deals, so these aren't necessarily numbers moving forward in the future, because things are definitely changing here. But just walk us through maybe an average of what you're seeing there.
Sure.
Yeah,
Absolutely. So kind of the projects we look for, we're old building, like I mentioned, we've bought them as little as $10 a square foot, $15 a square foot for 75, 80,000 square foot buildings, right? So we might buy a building for 1.5 million, and then we're going to put about 2.5 to 3 million into converting it into self-storage. So we're all in for, let's say, 5 million. Typically the appraisal that we have when we buy the building, if it's a good market, the appraisal will be higher than our purchase price. So let's walk through like the one we did in Danville, Virginia. That's a we did. So that one was a little more expensive. We paid just over 2 million for the building, but the appraisal from the bank was 2.5 million. So we had a few $1,000s of equity, day one. And then once we finished converting it to self-storage, that took about 12 months. Appraisal from 9 million. And then when we stabilize the property and lease it up over the next 4 to 5 years, stabilized value is about 14.5 million. So right off the bat.
So real quick on that. So you bought that property for 2 million, 2.5 was the appraisal, 12-month conversion. How much did you put into the construction to get it to that 9 million? You remember?
It was 3 million. So we were all in for 5 million or so.
Okay.
Yep. So our loan to value, which of course is a key metric for banks, our loan to value when we purchased the property was 70% because we had to bring in 30 down to buy the actual building. And then the construction loan, once we were past the construction, our loan to value immediately dropped to 40% because now we have an asset that we've got 5 million into that is worth 9. And then I'm sorry. Yeah, that's right. 5 million. We're just under 5 million. Say 4.5, and it was worth 9.3. So we were about 45% loan to value at that point. And then as it stabilized, our that's going to just continue to drop, and our going to change, but the value is going to go up to 14 and a half million. We're going to be 30% loan to value at that point. So that's a tremendous amount of equity right there,
Yeah.
right? So
Yeah. I mean,
so
you
our
doubled
plan
the
was to
equity in just in a year, essentially.
right,
Right. Yeah.
exactly. Yeah.
Yeah.
So what we typically tell investors is our target is at about a 20% IRR for them, or a 2x multiple on their investment over 5 years. And we can easily finance the property at 50 or 55% loan to value, get that cash out, pay off investors, back their preferred return and return of their capital, but we investors in the deal. So they're going to be still getting cash flow as a pro rata share of their equity of ownership in the project. And so that's infinite cash flows for them, right? So if we keep it for 10 years, there's another 5 years where they're getting cash flow. They've already gotten all their money back. They've essentially their money in 5 years, which roughly translates to about a 20% IRR. And now they're whole and into another deal with their cash if they want, but they're still in on the first deal. And so they're still going to get cash flow for 5 more years. And the beauty of cash out refinance is you're just putting more debt on the property. So all of their return of capital is not a taxable to them. It's tax free because it's just more debt.
Right.
So let's say somebody came in with $50,000. That gets a class share for our typical deals. And then in 5 years, we turn that into 100,000. They get their 50 back plus their of profit, call it profits, but it's really more debt that we put on the property, but they're still invested in the deal. So they're still going to get below. And then in another 5 years, like say year 10, we're going to sell the asset and then they're going to get another bump. I'm not sure exactly, we'll see what that number is, but it's going to be a healthy number as well. So in the meantime, they can take that initial investment and the return on that investment and put into another deal that we have going, or take the cash and go on to something else. That's kind of our model. And that's, that deal is pretty average for us. We typically find those kind of deals, we just take down 3, 4, 5 a year and on to the next one.
Yeah, no, I really attracted to that model too, because I mean, as an investor, hey, I can put $50,000 in 5 years, and I would imagine 5 years is a goal, but sometimes that could be 3 years, right? I mean, just depending on
Yeah,
the market and where interest rates
sure.
are. But let's just say so in 5 years, I take that money back, I leave it in the deal, and like Eric was saying, I'm cash flowing on zero. I mean, I have all my capital back where I can go and reinvest that
Right.
into either another storage unit, a multifamily, or whatever, right?
Sure.
So,
Yeah.
I mean, that's
Yeah. Some groups take the investors out at that point. Like we promised you this, we gave you that, we gave you all your money, and now you're out of the deal. We go on and we're going to keep the asset or whatever. But we didn't want to do that. We wanted to leave the investors in because we really value their contribution to helping us build these projects. So yeah, it's great for us to leave them in. We're going to get cash flow. They get cash flow. And, I mean, the jury's out. Like maybe after 10 years, we refinance it again.
yeah,
And take more cash out, still not taxable, and keep going the cash. Maybe it's legacy property where we keep it for 15, 20 plus years. That's how you build a stream of income that you reinvest your initial capital or your gain on your capital into something else. You've already built one stream, right? So you're whole, and now you can reinvest it into another stream and another stream. And it's not a sprint, it's a marathon.
yeah.
It takes time to build these, but easily could be 7, 8, 10 years. You've got several streams coming in. That is, I think, a fantastic return. I think you'd be hard to find a better
Yeah.
way to do it, in my opinion.
Yeah, I agree, especially with the low maintenance too, and the mitigated risk there. So,
Right.
what is the typical cash flow once you get everything stabilized that they can expect for a year?
So it depends on where we're at in the cycle. So all of our investors get a preferred return. So their money is earning interest 6 or 8%, depending if it's a Class A or a Class B share, as soon as we deploy the capital, right? So as soon as
Right.
we buy the project, that their money's working. It's getting 6% return or 8% return. And then as we get cash flow, the investors get paid we obviously the first year we're under construction.
Right,
Their money's
right,
still earning a preferred return. It's just building up. But we don't have any cash to pay them yet because we haven't started renting units. Then once we start renting units and there is cash flow, all of that goes to investors to catch up their preferred return. So we don't get any cash flow. The investors are caught up on their pref, right?
right.
So then after we get over that waterfall of the preferred return, then it goes pro rata. And I don't remember right off the top what those numbers look like, but a B investor we expect to get 8 to 10 to 12,000 a year return on that 50,000. So it's still going to be 15 to 18% return on that 50,000. But then when they get the 50,000 back, they're whole, but they're still getting that 12, 18,000 bucks a year.
Yeah, so I mean, you could say maybe an average cash on cash return throughout the hold period until that refinance. I mean, of what, 7-8%, kind of right in that range.
Yeah, I mean so the IRR works out. I mean, we target a range because we're going to pay them back after the refinance. It's typically 18 to 22% IRR.
You just go based on that.
So yeah, which that's a hard number to hit. Unless you're an active investor. That's for a passive investor. Active investors can do that or better, but that's that takes skill, that takes time, that takes risk, all of those things. And this is an asset that they don't have to even visit, never have to go there, never have to rent a unit. We tackle all of that. So we're vertically integrated. We have our construction company. Nomad Capital is the syndication group, obviously, and then we have our own in-house storage that we manage the assets with. So, so that's the advantage for a passive investor for sure.
Yeah. Well, and thanks for walking us through that, because I think it's helpful to put numbers to an actual deal and kind of walking us through that process and seeing how this works. So
absolutely. And of course, when we launch deal, we have, a 65-page offering memorandum that breaks everything out. Happy to share that. Right now, we're in the middle of a fund, our first fund that we're calling El Fundo, and it's a $10 million fund.
Yeah.
So we're be across 5 assets, and we've already bought 2 that are in the fund. And so this year we're going to close out and buy 3 more projects. So anybody invested in the fund will be sharing in all 5 of those properties, right? So that helps blend the risk a little bit. Yeah. If some properties perform better than others, everybody that's in on El Fundo will be across all 5 of those assets. So, and same kind of thing, 50 is a minimum, and 250,000 is Class A share. So, and that's a 506C offering. So, unfortunately, that's open to investors only.
Yeah. That makes sense. Yeah, and the fund model, I mean, is very attractive too. I mean, as an investor, again, it, like Erick said, it just spreads that risk out against 5 assets instead of 1, right? So if one's
absolutely,
exactly, like it's projected, which, I mean, it's real estate. There's risk involved sometimes. Sure. And a lot of times it's just really depending on the market. It's kind of where we're at right now with these high interest rates. A lot of people, especially in the multifamily space, are did everything they said they were going to do, but just the market being to where it's at right now and the interest rate increase, it's tough to, get some of these capital back and refinance or sell properties, right?
Yep.
And you got this, a lot of them have the bridge loans coming due. So anyways, not to get down that topic, but anyway,
that's a great point.
Huge. Yeah.
Yeah, that's a great point because, we talked about oversaturation being one of the risks. Storage, and of course the next would be interest rates, what kind of debt you have on the property, and we feel like we're in a good position right now. A lot of our properties are, we've got some at 3.75 fixed for 5 years, so fantastic loans. Some of the more recent ones we've gotten squeezed, but that just means we have to be better, right? We have to find better deals, and we're paying 6.5. I think we have one at 7%, but if it works at 7% and rates trickle back down into the 5s, that'll be the same time we're going to refinance. So that's just going to launch the cash flow at that point, because it works at 7%. going to work that much better in the mid fives or low fives or wherever we wind up in a couple of years. So yeah, we don't do any variable rate debt. We bridge debt. We have a lot of great relationships with local lenders, regional lenders, community banks. We don't want to get squeezed any more than anybody else. So yeah, so I would say those are probably the two risks for storage would be saturation and wrong debt that's not structured right for the long haul. So
Totally agree. Well, Eric, let's go ahead and transition here into our fire round.
okay.
What I'm going to do is ask you 4 questions. First one being if you could recommend a book on real estate for investors just starting out, and another book that is particularly good for cultivating a positive mindset.
Yeah, absolutely. So I read right when I first kind of went on my own in the early 2000s was Rich Dad Poor Dad. Even though it's not a real estate book, a lot of people is, but it's just a way to think about where you're going and how you're structuring your life differently. If anybody hasn't read it, fantastic read. Really kind of breaks down what's an asset, what's a liability, where does a business owner fit with a investor versus somebody that's self-employed or somebody that's an employee. Just kind of getting out of the W-2 mindset. So that's a great book. Real estate focused, I would say Millionaire Real Estate Investor by Gary Keller. Keller Williams, real estate founder. Great book. It's focused on obviously commercial real estate, but it just really is a mindset shift on how to think about commercial real estate, how to build a network, a team, brokers, attorneys, accountants, staff, just kind of all the people. It's definitely a team sport. And so you need a group of great people around you to support you. And so that's a fantastic read as well.
Yep. No, yeah, great books there. I've definitely read them both. And just going back to the Rich Dad Poor Dad, it's, like we were talking about, Eric and I met at a, coaching program, right? That was tailored mostly to, how do you get in a positive mindset, right? Get your mindset right. Because I think a lot of this, I'm a true believer that 80% of this stuff that we do is mindset, right? We got
Absolutely.
to get in the right frame of mind, and of course, the other 20% is action and, doing the work, but just having the right mindset, which that Rich Dad Poor Dad, if anybody has not read that book, highly recommended. Stop the podcast now, go get the book. That was a game changer for me for sure.
Right. Well, something I've been thinking about lately as it relates to that is people, you talk about looking at businesses or real or whatever, you're talking about, well, let's look at the financial, look at the P&L and the balance sheet, right? That's typically what people want to look at, or, kind of those are the that you judge a business by. And people are usually hesitant to oh, I'm not really an accountant. I don't get it. I don't want to weeds and the balance sheet. I don't understand what all the numbers are. Every person has a P&L and a balance sheet, right? Yeah. So you have income and you have expenses and you have your net worth, right? Whether it's your house, business, cars, credit cards, everybody has a P&L and a balance sheet. You don't have to call it that, but that's what it is. So you get familiar with those and how they work, because that's the game, right? So yeah, a little bit about what we talked about earlier about, saving up for retirement and trying to go the long way. I think that over where you can save your way to retirement, honestly. We've seen it over the past couple of years with inflation. So you have to take bolder steps. You have to take bigger in the batter's box, right? And so that's why I think, commercial real estate or some kind of investing into real estate, an aggressive approach is the only way you're gonna make big strides.
Yeah. Yeah, no, 100% agree with that. I mean, and just like what we're talking about is just a different bucket. There's tons of options out there, but just let your money start working for you,
right?
and try to stay ahead of inflation, because like Eric said, you got money just sitting in a savings account right now, even in the money markets, right? They're earning 5%, which is great, and definitely you want to earn in something, but you're still paying taxes. Even if you have it in a real estate deal earning 5 to 7%, well, you're going to essentially pay little to no taxes on that money because you're going to get the depreciation of that asset, and you got a potential upside as well. So,
right. Even if, I agree 100%. If you have cash sitting, it is going down in value. No question about it. Even 5%, because you're going to pay tax on that interest. So by the time you take out the tax, whatever tax bracket you're in, you're really earning 3.25%.
Yeah.
That's where the Fed's trying to get the inflation rate now. When inflation's at 5 or more, you're losing money.
Yeah.
So if inflation's at 10, you're taking a bath. I mean, there's
Exactly.
just no question about it. It's a simple mathematic equation that you can show, like, unless you're significantly beating inflation, there's just no way you're going to get it. And that's just kind of how the system is designed.
To that point of that's why Eric and I are doing what we do, right? We're helping educate others because a lot of people don't even know. They don't even think about this
I
stuff,
know.
right?
I know.
They're,
Yeah,
they're,
it's really a tragedy.
yeah,
Yeah, we've homeschooled our kids, and we have a lot of talks about financial stuff. Not that we're money, but money's a tool, right? Money's a tool going to live your life, and you're not going to go try to do a framing job with a screw gun. You need a hammer.
right.
So you're going to be dealing with money your whole life, is what I tell my kids. You might as well figure out how it works and how to get ahead, because nobody else is teaching. Nobody else can show you. I went through the school system, and there was zero about how to balance a checkbook or even financial statement was. So we can't count on others to do it for us. It's something that it's our money, and we have to, step in and educate ourselves and then take action. That's the name of the game.
Yep. Yep. Definitely taking action. Well, it's funny. They teach us how to solve all these, mathematical, very, extreme, difficult equations, right? Which I'll be
Right.
honest, I've never applied to any of my life, since I graduated high school. And, but they don't teach you how to do a P&L,
Nope.
or
Nope.
write a check or balance a checkbook or anything like that. So I
Right.
agree. It's
Yeah.
yeah.
I
I
mean,
don't
I
want
did
to.
it. I did
Yeah, go
I did
ahead.
calculus and trigonometry and geometry and all that. I mean, it's great stuff. Super interesting seeing how all these formulas work and all that, but it doesn't put food on the table unless you're going to be an engineer. So,
Yeah, or
um,
scientist or
I think
something. Yeah,
I think
yeah,
your money, your time is much better spent getting financially educated. So,
yeah,
I'll dovetailing on the Rich Dad Poor Dad, he's got a couple of games. One's for kind of teens and adults, and one's for younger kids. And we bought them both, and they're fantastic. I mean, they just really break down a lot of the concepts of how money works. And really, it's cool to see kids grasp that. Like, oh, okay, if I put my money here, it's going down in value. If I put it here, it's going up in value.
yeah,
So, I mean, the tagline of the game is how to get out of the rat race. So that's what it's about.
yeah, yeah. Absolutely. All right. Well, let's go into our next question here. What is the practical first step the audience can take to explore the space of passive investing?
So I think education, like we just talked about,
Yeah.
just educating yourself with what's out there, what's available. There's some fantastic opportunities out there. There's some great syndicators. Unless somebody's really willing to dive in and roll up their sleeves and go at their themselves, I think there's so many great groups. We'd love to chat with anybody that wants to talk about what we're doing. Happy to have conversations with people about get involved with the self storage space, specifically conversions and the Southeast. A lot of people know the Southeast is just on fire right now with people moving in here. So many huge companies are coming in with factories and a lot of industries. We feel like there's a long, long runway for our kind of projects, and be doing storage forever. I don't know. I mean, we're definitely heavy into that right now, but we know that we're learning skills that can be transferred to other asset classes. Maybe it's converting one of these mills into a multifamily project, or converting office into multifamily or industrial spaces or cold storage, or the list goes on and on. We just feel like there's so much opportunity. It's just super exciting. We have to stay. We're really. It's hard for me to stay in my lane, but this is where we're at. So this is what we're getting better and better at. I would love to look around at other asset classes and see what else there is. So mindset is definitely the first step for people to take. Mindset and education.
Yeah. Yeah, it's so easy. Just there's so many shiny objects around, and just it's just, you get into one thing, and y'all have done well, it sounds like, of just niching down in the soil storage space. So that's been good. I've been guilty of, all right, multifamily, but oh, this looks attractive. I mean, you can get into debt funds, you can self
Right.
storage,
Yeah.
ATM fund. I mean, there's just so many stuff once you open up
Well,
the
it's yeah.
yeah.
Well, it's you can kind of run the risk of sitting on and kind of waiting for the perfect opportunity, and
Right.
that will never happen. It'll never be one up. Like, yes, of course, there's some that are better than others. No action is the enemy of good action, right? So you can just have an analysis paralysis where you just, well, this looks really good, this looks good, but I think there's something better, and waiting for something better sometimes it can be just an excuse for fear that you just don't want to take any step.
Yeah. Well, and I agree. I think that's the biggest thing is just get started doing something. Now,
Get
of
started.
course, do the education, make sure
Of
you're taking
course.
it, educated risk, so to speak, but
Yep.
you got to get started and then you learn along the way and then you learn what not to do moving forward. Right. And so
Right. Yep.
that's the biggest thing. And once I got over that threshold of that analysis paralysis, oh, this is scary. I'm investing a lot of my money. It was just like now it's just another number on the spreadsheet, right? It's just
It's scary. I'll be the first to admit it's scary, but
yeah,
perfect is the good.
exactly. All right. So next question here. What is a daily habit you practice keeping you on track towards your goals?
I don't do it every day, but I like to meditate, just refocus, because there can be a lot of these, texts, emails, all that. So that's a great way to refocus. Meeting with my son, my partner, we get along really well, and it's great for us to connect and just kind of, get on the same page and where we're at with the business. He's tackling more of the day-to-day operations of the business. So those are probably two habits that I do.
Awesome. Yeah, definitely love the meditation piece. I definitely incorporate that to my daily practice, and it's been
Yeah.
made a huge difference, in my life for sure.
Yeah, yeah. Most of my meditation looks like riding a bike. I like to ride in the morning. There's a lake nearby, so I ride around that. It's a 10-mile loop, and that's a great way for me to put the AirPods on, check out, and just kind of assess the day and kind of recenter.
Yeah, absolutely. All right. So last question here. If you could be remembered for one thing, what would that be?
I think I would love to be remembered that just not being ruled by fear, not being afraid to take risks. Yeah, I think just kind of making the most of the opportunities that were presented to us and or to me, and I think that'd be a fantastic way to leave the world. I want to always be known that I put first. That's why we're building this thing. Have something to hand to the next generation. We've got 6 kids. I don't remember if we mentioned that, but we had a baby in Israel on our sailing adventure. We've got a lot of legacy to leave, and I would love to remember for that.
That's cool. Well, yeah, and I think it's pretty awesome. You and your son are running this company, and that y'all work well together. I know from previous experience that's not always the case working with family.
It is not.
Um,
We're extremely blessed.
yeah, yeah, definitely. Well, and yeah, just leaving that legacy is that's the goal, right? We're just
Yep.
creating generational wealth here. So
Right.
yeah. Well, I love that, Eric. I've definitely enjoyed our conversation today. And before I let you go here, if you could tell listeners how to connect with you, if they want to learn more about the self-storage space and yeah, what you're doing.
Absolutely. Yeah. So the easiest place is our website. So it's nomadcapital.us. And there's a tab on there. You can invest now. You can read about our OMs. You can schedule a call, or feel free to reach out on myself, 910 431 3855. Happy to chat with anybody about what we do, how we do it. You want to peek under the hood, we're happy to send you, an offering memorandum for El Fundo. If you want to get involved in that, we'd love to have you. Super excited to chat with people about their journey and what their goals are and how we can help them get there.
Awesome. Well, and two, if for the listeners, if you had, you know, any value out of this podcast today, please share it with a friend, a family member. Again, going back to Eric and I's goals here is just to really help educate others on how they can get involved in this space. So, and if you could take a moment, if you like the show, rate and review, it definitely helps us out. And I'm just excited to see what Erick and Nomad Capital are coming, and here in the near future, the progress they're making. I love the name, the El Fundo, by the way. I just had to throw that out there.
Yeah, thank you. Thanks.
Yes.
Yeah, we saw every other group does fun, and we're like, that's kind of boring. Like, so we went for El Fundo, and
Yeah.
that's what it is, El Fundo LLC. So goes back to our time in Costa Rica where we learned Spanish. So
There you go. There you go. That's all.
yeah,
All right, Erick. Well, I'm sure we'll be talking soon.
great. Thanks, Jarod, and yeah, appreciate you having me on.
Yeah, thank you. Thank you for listening to the Optimal Wealth Podcast. If you enjoyed this episode, please be sure to rate, review, subscribe, and pay it forward by sharing with a friend. Most importantly, be sure to optimize your results and take massive action on what you have learned here today. For more, visit optimalequitygroup.com.